If you think about 1990s, monetary policy is very similar. Remember that the Fed jacked up interest rate in 94 and did so without causing recession. That was actually the first time the Fed raised interest rate very aggressively without causing recession. Before that, every time the Fed hiked rates, the US economy always fell into recession. That was the first time. Now the Fed did the same thing in 2021, 22, and so far we don't have recession. That's very similar. Back in 90s, we had a dot-com bubble, we had internet revolution, we had a huge investment in the information technology at the time. Today we have artificial intelligence, we have data center investment that is going through the roof. Very similar. If you look at the magnitude of investment in the data center right now, actually the contribution of data center investment to GDP growth is very similar to consumer spending. That was quite shocking. Don't forget that the U.S. economy is basically driven by consumer spending, and data center, in terms of contribution to growth, is very similar to consumer spending. So that is very similar to, if you think about policy at market volatility is very similar. In 98, remember, the stock market dropped 20% because of the LTCM crisis, and Fed moved in and dropped interest rates 3 times. And then that basically set the stage of a parabolic move in stock prices. I think April, if you think about the decline in stock prices on the so-called tariff tantrum, the magnitude of decline is about the same. It's about 27%, and then actually the speed of recovery was basically the same thing too. So all of that basically led me to believe that the next rate cuts, I don't care whether it's twice, 3 times, whatever, monetary easing, probably going to set the stage of a pretty significant move, the final last up leg in the U.S. equity market, particularly in tech stocks. So in other words, I'm still using the 90s as the roadmap for what may happen going forward. So I'm not ready to leave the party yet in the U.S., in particular in the so-called Mag 7. I think there will be another up leg, major ones, that is going to happen. And then after that, everything is open to question. Could be a burst, could be a bust, it could be anything. But I think we're not yet. Remember one thing, last thing I want to remind your watcher, your TV audience, is that actually there's old saying the bull markets do not die of old age. The bulls are all get slaughtered by the central bank. So as long as the central bank don't raise rates, bull market usually continues. Now we're into the easing cycle. So this thing's getting a bit of a distance to go.
Okay, so Chen Zhao, just to recap, right? You had a lot of ideas there. You're seeing it's never apples to apples, right? But the closest corollary you can see to the situation today is the back half of the 1990s, 98 to be specific. Yes. LTCM crashed, Fed cut. Market made a parabolic move to the upside. You think the same thing is going to happen regardless of whether the Fed cuts, I don't know, 3 times this year or 3 times the next year, right? It's going to be a parabolic move higher. It's going to be led by the Mag 7 and AI. Does that mean you do not think... productivity growth. Does it mean you do not think that we are in an AI bubble, as Sam Altman has been claiming?
We are not yet. I think we will be. So bubble has to be carefully defined. If you remember dot-com bubbles during that period of time, the companies, as long as you call yourself dot-com, basically people throw money at you. The PE ratio was infinity. We're talking about the companies that are going IPOs. If you have a positive earnings, you're usually selling at a lower prices than you don't. So that is a classic sign of a fraud. And not to mention, at the time, the multiples are way higher than today. I think at the time, S&P was about 40-some times forward PE, where today 22. So we are Don't forget, and also the equal weighted index is only 18, 19 times today.